Welcome to the Streamline Podcast, where we discuss retirement and the strategies to make your retirement the best stage of life yet. I'm Dave Zoller, owner of retirement planning firm Streamline Financial, and today we're talking about Mega Backdoor Roth Conversions. We'll explore what they are, how to do them, and then the mistakes people make. But then we'll also look at a case study with some real examples and visuals to make it easier to understand and see if it actually makes sense or applies to your plan. And then we'll look at a 3-question filtering system to see when the right time to apply this strategy could be. To begin, I'd actually like to start with the case study about someone who wants to see if the strategy is right for him. So Mark wrote to me and he said, "Dave, I've been contributing to my 401k for years, and I'm looking for ways to maximize my investments. Most of my retirement is tied up in my 401k, and now I'm thinking about the potential tax impact of doing this down the line, of actually taking withdrawals out, I'm assuming, down the line. What do you think about Mega Backdoor Roth Conversions?" Well, first off, that's a great question, Mark. To find out, let's clarify. First, what is a Roth conversion? We probably know what that is, but let's just do a quick look here. Typically, when you convert or add to a pre-tax IRA or 401k here, when you put money in, you get a tax deduction that year that you make the contribution. That means you don't pay taxes now, but you will when you withdraw these funds in retirement or whenever you take the money out. That's when you pay the taxes. Now, when we're looking at Roth conversions, that's when you're taking money from the pre-tax IRA or 401k and then adding it to your Roth or tax-free account, we could call. And when you do that, that's when you pay the tax. But then the goal is hopefully there's growth in this account. And then when you take the money out, then you're not paying additional taxes in retirement. Now, when we're talking about the Mega Backdoor Roth Conversion, we're talking about our 401k strategy, and that allows us to contribute significantly more to the Roth accounts than the standard limits. It's like supercharging your retirement savings in a tax efficient manner. So let's put some numbers to this for Mark so we can understand this even better. So the standard 401k contribution limit is $23,000. This is for this year. That's the standard amount. Now Mark's over 50 and he can do the catch-up contribution of $7,500. And then there's also a match, an employer match of $8,000 a year. So all in, Mark is getting in $38,500 into his 401k. That's great. But did you know that the IRS max contribution allowed into a 401k is actually much higher than that? And this is great for pre-retirees who really want to boost the amount of money in their Roth accounts, because the max is actually $69,000 for Mark. So an extra $30,500 is what he could be getting into his Roth bucket if the company plan allows it. And let me show you a picture to better explain how this works. And by the way, as I'm pulling it up, if you like this, please click the like button so I know, and then I could do more videos like this. And also let me know if you have any money questions or things top of mind about retirement, and I could do future videos about those questions. So within your 401k, there are 3 accounts or 3 buckets that you can put money into. We're used to 2 of them. The first one is the pre-tax account, which we're used to. Every dollar you put into this account or bucket will be tax deductible in the year that you contribute. And then all of the growth, whatever you pull money out, that's when you pay the tax. The second bucket or account is the Roth account, which most 401ks now provide this. And here, every dollar you put in the year that you put that money into the account, you'll be paying tax on it. It's not a pre-tax contribution, but the growth and the distribution, when you take out, should be tax-free to you. And then the third account is really the most unappealing account unless you use it the right way. It's unappealing because it's kind of the worst of both worlds when you compare these two. The worst of both worlds when it comes to taxes. This is the after-tax account. When you put money into the after-tax account, it's going to show up on your tax return, so you're paying taxes. It's part of your taxable income, and all of the growth that happens in the account is taxable when the money is taken out. But that's where the Mega Backdoor Roth Conversion can come into play. Once you put money into the after-tax account, you may be able to roll it to the Roth account, essentially allowing you to put more money into your Roth account every year for that tax-free growth and distribution in the future. So for Mark, he was able to put in, let's pretend it's all 38,500, and let's just say that it's going into the Roth, and then he's got an extra 30,500 where he can do this potentially backdoor Roth conversion. Now, a big step here for Mark, if he's going to add that $30,000 to the after-tax bucket, before there's any growth or taxable growth, he'll want to roll it into that Roth bucket where he'll be able to get that tax-free growth and then the distribution in the future. Now, there's a few big questions that come up. One of them is, what time of year is the best to do this Roth conversion? And another question is, how do I know if I should even do this? What should I be testing to see if this makes sense for me? So first, what's the time of year? What's the best time of year? As with all financial strategies, there's timing and personal circumstances play a big role, right? One key consideration is market performance. In an ideal scenario, we do a Roth conversion when the market or the investments inside the account are at their lowest point. This is why we've got so much activity at Streamline Financial during temporary corrections, because there's some proactive strategies that our clients take advantage of during down periods. It's what we call the ANTIfragile Retirement Plan. And it's a plan that doesn't break in bad times, but it actually substantially can improve itself. And if you want to see that, I'll include a link at the end of this video. But back to the backdoor Roth. The reason why we want to convert during a low point is because lower market valuations mean that you can convert more shares to a Roth at a lower tax cost, which can potentially lead to more significant tax-free growth if and when the market recovers. Another aspect to consider is your cash flow. This strategy requires a substantial cash contribution. It's that extra 30,000 or so if you're going to try to go for the max. And not everyone may have the liquidity to make such a large after-tax contribution. Sometimes people will build up their bank account or their taxable brokerage account to fund these Mega Backdoor Roth conversions. So when it comes to the best time to do this, in my opinion, since we can't time the market, or if we know if there's going to be a correction or a down period this year, I would say think about doing the conversion when you've got the cash available. If it's in the beginning of the year, that's great. Hopefully the investments go up over the year, the whole course of the year. Worst case, let's pretend you do it in January and the markets go down 10 or 20%. This means that if Mark put in $30,000 and now the value is maybe 25,000 or so. Now that's kind of an extreme worst case, but you can also look at multiple period contributions if you want to do something like that, sort of like a dollar cost averaging, where it's not a lump sum at one point in the year, but a few contributions throughout the year. Again, my personal thought here is I would get it over with and then move on, and versus trying to time and spread it out in some fashion. Because when you analyze a lump sum versus dollar cost averaging, if you look at history, it's shown that investing lump sum typically produces better results. Now let's explore some of the common misconceptions or mistakes around Mega Backdoor Roth conversions. One common myth is that the strategy is just for the ultra wealthy. Well, it's true that those who have higher incomes might get more benefit from this from a tax perspective. It can also be a strategy for middle income earners that's maxed out their traditional retirement contributions and they're looking for additional ways to save. The last few years before retirement are really they can be the highest income earning years for a lot of people, which could be a good time to funnel more into their Roth. Now, some important things to remember. When you opt for this strategy, you're essentially choosing to pay tax now in exchange for tax-free growth in the future. And this can be a significant advantage, especially if you expect higher tax rates or a higher tax bracket during retirement. However, this also means that you're missing out on tax deductions and the benefits of that currently. So balancing these is key. I'd say running a tax projection for yourself or with a wealth management team is a good idea. If you don't have a team that specializes in retirement strategy, reach out to me by clicking on the button below this video. And I'd love to have a call if we've got the availability. Now, another mistake is not immediately converting after-tax contributions to the Roth account. So it's this step from once you put the money in, not immediately getting it to the Roth, because delaying that could lead to some growth within the account and some of it then being taxable upon conversion. Another mistake that we see is just not paying attention to the changes in this rule and the IRS limits and the rules that come to this. Just spend a lot of time on this. Work with an expert before you think about doing any of this. Don't rush into it. But there's a lot of nuance, as with any financial thing. So take your time. Next are the 3 questions to help filter if this is going to be worthwhile for you. And by the way, if this has been helpful, please click the like button or leave a comment below. And then also look for the Anti-Fragile Retirement Plan that should pop up on your screen right after this. So the 3 questions to ask yourself are you already maximizing Roth 401k contributions? Right? You want to max that out before you even think about doing any sort of mega backdoor Roth. Number 2 is, do you have the cash flow? Do you have the cash set aside to make a big after-tax contribution without impacting your current financial picture? Just meaning you wouldn't want to be tapping your emergency fund or going into credit card debt, in my opinion, to do this. Number 3 is a big one, and that is, do you anticipate being in a higher tax bracket in retirement? Now, some retirees, they move to lower tax brackets after work. So Roth conversions don't always make sense. So you want to do a projection and see what potential tax brackets could be when you retire. And again, I hope this was helpful. And then here's the video on how to create an unbreakable retirement plan. And then I'll see you in the next video.